Okay, let's just dive right into this explainer and unpack how a historic wealth event can literally teach us everything we need to know about mathematically sound investing for 2026. Right now, thousands of people inside a certain rocket company are about to wake up generationally wealthy. The rest of us, well, we're kind of stuck watching from the outside, wondering if we should chase the hype or just stick to our boring financial habits. So we're going to break down exactly how this massive wealth is being created, whether you can realistically get a piece of it, and most importantly, how to build an unshakable financial foundation regardless of what the market does next. We absolutely have to start with the sheer unprecedented scale of the SpaceX IPO. This is a rocket company now targeting a valuation of $1.75 trillion. To put that massive number into perspective, because honestly, the human brain just kind of glazes over at that scale, this single company that builds rockets is worth more than the entire gross domestic product of countries like Australia or Spain. This isn't just a big public offering. They're looking to raise around $75 billion, essentially lapping the previous record holder for the largest IPO in human history. It's just wild. And notice how this valuation didn't just creep up. It climbed like an absolute ladder over an explosive 18-month stretch. During this time, insiders essentially cashed out at every single milestone, all while normal investors were completely locked out. I mean, the company went from a $350 billion valuation to $1.75 trillion in roughly a year and a half. Every time that number jumped through what are called tender offers, early employees and inside investors got to sell shares at a higher price. The machine worked exactly as it was designed to mint millionaires right there inside the building. But the employees are really only half the story here. This staggering 62,000% figure represents Founders Fund's return on their 2008 bailout bet on SpaceX. It completely proves that the absolute earliest money makes the most absurd gains. Think back to when SpaceX had failed 3 launches and was literally running on fumes. Founders Fund wrote a $20 million check. That bet has now grown to over $19.5 billion. That's a return so massive it totally eclipses the value of their entire fund's other investments combined. Unbelievable, right? Okay, moving on to Section 1. 4 routes to SpaceX. Let's see how regular people might actually get in. Look, each of these 4 routes comes with a pretty massive catch, from fixed low allocations and day one market frenzy to crazy restrictive wealth requirements. If you try Route 1 and request an allocation at the IPO price of $135, you're likely only going to get crumbs because the demand will be absolutely biblical. Route 2 is buying on the open market, but that means paying whatever hyped-up price the crowd sets on day one. Route 4 involves buying public funds or Alphabet stock since they own a piece of SpaceX, but you really have to watch out for massive fund premiums there. And then, well, there's Route 3. To even use Route 3, you run headfirst into the accredited investor definition. This is an archaic 1982 rule that legally walls off this path for over 80% of American households. The pre-IPO secondary market sounds incredibly glamorous, right? But to get in, the government says you absolutely have to be an accredited investor. And keep in mind, these dollar thresholds haven't been adjusted for inflation since the year the Macintosh computer was invented. If you don't meet this specific bar, this entire avenue of buying private shares from early employees is fully legally closed to you. So if you try Route 4 instead and buy into a closed-end fund like the Destiny Tech 100, which holds SpaceX, you really have to look at the math. Buying through hype-driven funds often means paying a massive enthusiasm tax. At one point, the actual assets inside this fund were worth $20 per share, but the market was actually trading the fund at $60. You're effectively paying $60 for a $20 bill. That premium is literally a tax you pay for your own excitement. And historically, those premiums have a nasty habit of collapsing right back to reality. Which leads us perfectly into Section 2, the trap of hype. We really need to weigh the excitement against the actual investment. Even Morningstar analysts are waving a yellow flag here, warning that while the business is obviously legendary, you are paying over 100 times revenue for a company that's currently posting a $5 billion loss. Yeah, SpaceX absolutely dominates launch and satellite internet, pulling in $18.7 billion in revenue. But fundamentally, this is a wildly exciting growth story strapped to a wildly expensive price tag. When you buy at these crazy multiples, you really have to ask yourself if you're paying a fair price or if you're simply funding the hype. And look, this hype isn't just a SpaceX thing. The entire 2026 market is terrifyingly top-heavy right now, with just 7 tech giants consuming over a third of the entire S&P 500. When you buy the broader US market today, you are essentially making a massive concentrated bet on just a handful of tech and AI companies, with 493 other businesses basically just along for the ride. It's a market structure that leaves very, very little room for error. Right now, we are looking at the second most expensive stock market in literally 140 years, with the Shiller CAPE ratio sitting at 40.7, a level that's only ever been beaten by the dot-com bubble in December 1999. Vanguard is actually projecting incredibly modest U.S. returns over the next decade. When you buy into a market that is this broadly expensive, your future returns naturally tend to be lower. That's not me being pessimistic, that is just the cold, hard arithmetic of investing. Okay, deep breath. Let's pivot to Section 3, the boring wealth machine. It's time to talk about automating your financial success. This exact order of operations is basically financial armor. You must build this before you even consider throwing money at a massive, volatile IPO event. Step 1 is capturing free money. Step 2 is killing high-interest debt, because let's be real, a 24% credit card is a guaranteed negative return. Step 3 is building an emergency fund so you're never forced to sell your investments just to fix a broken water heater. Then, and only then, do you optimize your long-term tax advantage buckets like the HSA and the Roth IRA. The math here completely proves that failing to capture your employer match is literally actually declining the only free money that exists in the entire financial system. If your employer offers a 50% match, that is a guaranteed risk-free 50% return on day one. Warren Buffett himself couldn't guarantee you those numbers. Yet millions of Americans leave billions of dollars on the table every year simply because the HR enrollment portal felt a little confusing. Don't be one of them. Then there's the HSA. This is the ultimate stealth retirement account and the only account in America with absolutely no tax doors, making it an unstoppable compounding tool. Most accounts tax you either at the entrance or the exit, but the health savings account, if you qualify through a high-deductible health plan, dodges the IRS entirely. You can invest the balance, pay your medical bills out of pocket today, and just let that account compound for decades completely tax-free. It's brilliant. Moving on to Section 4, Index Funds over Experts. Let's look at why boring beats flashy. So, you might be thinking you need a high-priced professional to navigate this overvalued market, right? But the data tells a totally different story. Over a 20-year timeline, 92% of highly paid professionals lose to a brainless automated index fund. It turns out buying the whole haystack is just mathematically better than hunting for needles. Only a tiny fraction of companies throughout history have actually created all of the stock market's wealth. If you try to handpick them or pay someone else to, you statistically miss. An index fund just buys every company, guaranteeing that you own the winners. And here's why it gets crazy. A seemingly tiny 1% fee quietly vaporizes $187,000 of your wealth over 30 years without you even noticing. Fees are literally the only thing in investing that compound against you with absolute certainty. That 1% you pay an advisor scales with your money, not their effort, quietly consuming a quarter of your final net worth. Sticking to a low-cost automated index fund puts all that money right back in your own pocket. All right, Section 5, Surviving the Next Crash. Let's talk about the incredible power of doing absolutely nothing. The data proves that your gut instinct to flee the market during a downturn is totally wrong and will statistically force you to miss the exact explosive rebound days you need to retire. The best days and the worst days in the market are practically next-door neighbors. 7 of the 10 best days occur within just 15 days of the worst ones. If you sell out of fear to protect what you have left, you lock in a permanent loss and almost certainly miss the aggressive rally that follows right after. When it crashes, I do nothing on purpose. I love that. Doing absolutely nothing during a market bloodbath is the single greatest superpower a retail investor can possess. Your automated transfers should just keep running, buying shares at a newly discounted price. You don't check the app. You don't listen to the doomsday forecasters on TV. You simply let the automated system you build do its job while everyone else is panicking. So, here's the ultimate question. Will you chase the hype? Or will you build the habit? The SpaceX IPO will absolutely mint millionaires inside their building, no doubt about it. But out here, your wealth depends entirely on the boring, brilliant habits you choose to automate today. You don't need a golden ticket to a private stock offering to become generationally wealthy. You just need to set up your buckets, automate your index funds, and relentlessly refuse to interrupt compounding. The market transfers money from the impatient to the disciplined. So, which one are you going to be?